Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, we share 3 travel names we like, we highlight an undervalued energy stock, Pimco's Mohit Mittal discusses how the coronavirus has impacted his team and the market, and we break down the basics and benefits of 529 college savings plans. Let's get started. Here are 3 undervalued names in the travel industry.
Fears surrounding the duration and severity of the coronavirus pandemic have weighed on travel stocks, creating opportunity for long-term investors. Today, we're looking at 3 of our favorite travel names. Our first pick is Expedia. While COVID-19 will stress Expedia's financial health in the near term, we think the firm will maintain its sizable network advantage over the long term once the virus is contained. True, Expedia faces elevated debt leverage in 2020, but we believe it has enough liquidity to operate under anemic demand conditions through 2021. We expect Expedia's network advantage to remain intact and possibly strengthen after the COVID-19 crisis, because we think smaller peers would be challenged to fund the substantial human and operational capital needed to replicate the company's platform. Further, Expedia's new management team is focused on reinvesting cost efficiency into loyalty and user experience, which should support its network advantage. We assign Expedia a narrow economic moat rating and a $127 fair value estimate. Norwegian Cruise Line Holdings remains a favorite, given its wide margin of safety to our fair value estimate. The pandemic's impact on capacity and occupancy levels are likely to be significant when sailing resumes. But recent commentary that pricing for 2021 has been holding up well implies that demand should recover. In our opinion, current concerns are transitory, and plenty of global demand remains untapped to support industry growth once the virus abates. Cruise companies are expanding the demand pie by tapping into new geographies and demographics via wider market segmentation than they have in the past. We think Norwegian can pivot nimbly to capitalize on evolving consumer trends and increase earnings per share growth by at least a double-digit pace annually between 2023 and 2027. We think shares are worth $25 apiece. Our last pick is Windham Hotels and Resorts. We believe investors are discounting the firm's brand intangible asset and switching cost advantages. While sales will be materially affected by the pandemic, we expect Windham to outperform industry demand this year, given its exposure to economy and mid-scale units in non-urban and off-interstate locations, and 70% of its room nights tied to leisure. These exposures tend to outperform when the economy contracts, and individuals emphasize road trips versus air travel, such as they are this year. Further, Wyndham's financial health remains good despite COVID-19 challenges. Longer term, the company's scale will continue to offer third-party owners advertising, reservation, and loyalty program reach that can't be achieved by smaller competitors. We assign Windham a narrow economic moat rating and a $63 fair value estimate.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, we highlight an undervalued energy stock.
By Morningstar's estimate, the stock market is about fairly valued. Today, we're taking a look at an undervalued stock from the energy sector that our analysts are excited about, Pioneer Natural Resources. Historically, Pioneer had been one of the shale industry's weakest capital allocators, but we think the company is now a poster child for capital discipline. It intends to reinvest only 70 to 80% of cash flows. The company will distribute much of the remainder to shareholders as a variable dividend that will keep payouts calibrated with the commodity cycle, thereby setting an example all peers should follow. We think its Midland Basin acreage contains enough top-tier drilling opportunities to support decades of high-margin drilling and should ensure Pioneer remains among the shale industry's cost leaders for the foreseeable future. In addition, the firm has always maintained an exceptionally strong balance sheet, even during periods of challenging commodity prices. In fact, its leverage has not been above 2 turns since 2009. We assign the stock a narrow economic moat rating, a stable moat trend, and exemplary marks for stewardship. We peg a fair value estimate of $151 on shares. The stock currently trades about 40% below that.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now, Miriam Schoblum from Morningstar Research Services interviews Morningstar Rising Talent Award winner Mohit Mittal.
Hi, I'm Miriam Schoblum, Director of Fixed Income Manager Research at Morningstar. I'm joined today remotely by Pimco's Mohit Mittal. Mohit is the 2020 winner of Morningstar's Rising Talent Award for Investing Excellence. He oversees Pimco's corporate credit trading desks for the US and emerging markets. He also manages a variety of multi-sector and corporate bond strategies, including co-managing the Pimco Investment Grade Credit Fund. And starting in December 2019, he became a co-manager on Pimco Total Return. Mohit, thanks for speaking with us today. How are you?
I'm great. Thank you, Miriam. Very nice to see you again, albeit on the screen. And I look forward to having this conversation today with you.
Terrific. Before we dive into what's been happening in the bond market, some of us have been working remotely for months now, and we've had to adapt how we're doing things. How has the pandemic impacted how you and your colleagues at Pimco are doing your jobs?
Yeah, so I think, this has been a new, unique reality. What we did in the late first week of March was we distributed our team into two different teams, one working out of the main location in Newport Beach, and then another team working out of our disaster recovery site about 20 miles away from the main office. And then some people working from home. So over the next 2 weeks in March, we kind of got used to working with these multiple locations through enhanced, video conferencing, through more, calls over the course of the day. And then by the end of second week of March, we were quite adept and comfortable working in this new environment. So on the whole, it was a kind of a learning experience in the first 1 or 2 weeks of March. But by the end of the second week, we were quite fluent at it.
Well, that's great. Yeah, we've all had to get used to doing things in different ways. I want to shift and get an update on Pimco Total Return and how you and the team responded to the extremely challenging market conditions earlier this year. So please walk us through, if you could, how the fund was positioned at the start of 2020 and what you and the team were focusing on when volatility spiked in February and March.
Yeah, I think 2020 has been uniquely challenging in many different ways for a lot of different people. So for the Pimco Total Return Fund, we entered March with much lower exposure to the riskier areas of credit markets and higher exposures to the more resilient and higher quality areas like the treasuries and the mortgages. Then from the second week of March to the third and the fourth week of March, we saw significant changes, both in terms of economic outlook and economic growth, and also from an asset pricing point of view. Growth expectations were revised down by 10, 15%, 20% in the 3 weeks of March. You saw significant weakness in oil prices that had implications for energy-related credits. And you also saw a significant amount of asset outflows out of fixed income and equity funds, which created need for liquidity and a significant opportunities across various areas. So our focus around that time was on thinking about three things. First was with respect to the impact of COVID-19 on economic output over the next few quarters, over the next year or so. Second was with respect to fiscal and the monetary policy response and the implications thereof. And then third was thinking about valuations and what that is telling us. So we engaged extensively with our economists, with our external advisors, with our regional desk experts in thinking about each of those three things. And then at the end kind of concluded that opportunity set has improved or enhanced. Valuations have cheapened up, and while there are risks on the horizon, valuations are compensating for many of those risks. So then we started thinking about how to take advantage of many of those opportunities. And on that front, the focus was on corporate credit markets as well as select securitized product markets. On the corporate credit side, our focus was first thinking about kind of higher quality investment grade corporates in sectors like telecom, like technology, like utilities, healthcare, housing, where the direct impact from COVID-19 would be very small and manageable, but the valuations, because of the prevalent fear in the markets at that time, had cheapened up significantly. So that was one area of focus for us. So the second area for focus within the credit markets for us was then around sectors that were more directly tied to COVID-19, and that included leisure, lodging, travel, and in that front, we focused on senior and the secured portions of capital structures of many of the companies, but on a much more on a kind of a name by name basis, kind of cherry picking some of those opportunities, where our view based upon our credit research was that while there will be uncertainty, while there will be significant cash flow drain in many of these companies, as senior bondholders, we would still be okay in spite of the volatility. And then lastly, on the securitized product side, our focus was again on kind of the AAA portions of the ABS capital structures, where because of credit enhancement, while there will be some volatility, the expected losses were very, very minimal. And because of prevalent fear, again, valuations had cheapened up to make it look attractive. So net kind of, quite an interesting time where we spent a lot of time in March, April, doing a lot of research about economy, about individual companies, and in the end, kind of adjusting portfolio positioning to take advantage of some of those opportunities.
Thank you. That's helpful. What are Pimco's latest views on how the coronavirus will continue to impact the economy for the rest of 2020 and into 2021?
Yeah, I think on that front, I think the first thing for us is to have a high degree of humility with respect to thinking about or making any kind of economic forecasts. Our group CIO, Dan Iverson, has emphasized that point multiple times. There is unusual degree of uncertainty with respect to the path of the virus, with respect to the path of the vaccine development, and then with respect to the fiscal and the monetary policy responses. With that said, in our likely base case scenario, we think this economic recovery that started in May will likely continue for the next few quarters, albeit in an uneven fashion, meaning that it won't be a straight line recovery, somewhat of a wavy recovery, but it'll continue for the next few quarters. However, it will be important to recognize that it could be several quarters, maybe 2021 end or even early 2022, before the growth reaches the levels that we saw in 2019. On the positive side, though, we have seen an unprecedented amount of fiscal and monetary policy response. And that has really helped cause a V-shaped recovery in asset prices. So from here on, as we think about it, we should continue to see a steady economic recovery, and that will remain supportive for asset prices. But in a scenario where either the virus situation deteriorates or the economic recovery does not come in line with those expectations, then you could see some correction in asset prices. And then finally, when we think about kind of investing opportunities in this environment, there are a lot of interesting opportunities in now as well. Firstly, on the interest rate space, I think while US rates have rallied, we think relative to what US treasuries are, relative to UK, relative to Japan, relative to Eurozone, there is still opportunity, or at least a value on relative basis relative to those economies. Mortgages also still offer a lot of value, particularly in this low yield environment, and recognizing that the Fed QE that also includes agency mortgages is likely going to continue for some time. And then finally, I think with respect to credit side, we are seeing a lot of exciting opportunities. This will be a unique environment. There will be a lot of disruption. So to an extent that credit investors have the flexibility to take advantage of many of these opportunities, then this will be a opportunity. This will be a rich environment or target-rich environment on the credit side as well. And then also similarly, with the Europe having recently passed the European Recovery Act, we are seeing opportunities in peripheral Europe. And then lastly, with respect to Asia, which is traditionally a savings-rich region, we're also starting to see some opportunities there as well, particularly in the sovereign, the quasi-sovereign, and select credit space, which will continue to do well as the economies there heal also.
So you've mentioned some areas within the corporate credit market that are looking attractive to you. But I'm just wondering to step back and get your thoughts on how attractive valuations are in the corporate credit market overall. Because as you mentioned, the Fed has come in with some very firm support for that market. The investment grade credit fund has gotten a lot of inflows, and investors have been pouring money into investment grade corporates in recent months. Now, as things stand today, what's your view on how attractive the market is more broadly? It's obviously not the opportunity it was back in March and April, but what's your outlook for it overall?
Yeah, I think you're absolutely right. I think the opportunity is not what it was in the March and April timeframe. Spreads have come in significantly from the wides that we saw in March. Investment grade spreads are about 200 basis points tighter. So kind of, when we think about it, spreads have tightened a fair bit, but they're still wider relative to the levels that they were pre-COVID. Now, a lot of things have changed since February as well. First and the foremost on that front is the fundamentals of the corporate sector. Corporate sector has had to issue a lot of debt in the last 4 months, as you would be, and our viewers here would be aware, given the massive amount of issuance. And the need for that issuance was to meet the near-term liquidity needs for many of these corporates. So the amount of debt has gone up. At the same time, the earnings will likely be weaker third quarter and fourth quarter as well, which net means that the leverage in the corporate sector is higher than what it was pre-COVID. Now, the question on that front is, where does the leverage go from here? And on that front, I think 2021, in high likelihood, the leverage should start to come down from the 2020 levels, and that will be because earnings will continue to improve, and then the corporate sector will likely use some of those excess earnings to reduce some of the debt that it has taken on in 2020 because of COVID-19. So fundamentals, while they have deteriorated, are likely to improve in 2021. Valuations we talked about, have tightened a fair bit, but have some room to rally. And then finally, on the technicals front, I think, while the spreads and the yields have come in on a global basis relative to Europe, UK, Japan, US investment grade yields and spreads still look more attractive relative to the options that investors have in those regions. So on a relative basis, the demand still remains strong, which sets up for a positive technical. And then add to it the central bank's corporate credit programs, the primary and the secondary facilities, which even though have not been used to the magnitude that they were planned to be used for, they provide a nice backstop if things were to deteriorate. So when we combine all of that, our conclusion is that while spreads have come in significantly, there is still some potential for spreads to tighten somewhat over the next 12, 24 months, and that will offer a good return potential for the investors. Now, I think the more important thing will be that the returns from here on will come a lot more from security credit sector selection than from the broad-based spread rally. And there, I think investors who have access to deep credit research, able to identify those companies, will likely do better relative to others.
Great. Well, you've talked a lot about where you're seeing opportunity, but I want to just hear from you. What's keeping you up at night?
Oh, I think there is plenty in this world right now to keep us all up at night. I think for me, the first on that list likely is the health and the well-being of all of our team members across the globe, our clients and their families. From an investment point of view, I think the thing that keeps me up at night is thinking about kind of ways to continue to deliver strategies and products that help our clients meet their objectives in this low yield environment. So while there is plenty to keep us awake at night, I think there's also plenty that make me super excited to wake up every morning and come to work. And on that front, I think the first and the foremost again is the talent and the diversity of our team that has continued to kind of, in this unique environment, work together and find ways to deliver value to our clients. And then second on that front of excitement would be the next couple of years would be a very target-rich environment for investment returns. I think the focus there will need to be on flexibility, thinking about flexible strategies that can take advantage of opportunities in credit across the rating spectrum, that can take advantage of opportunities in the securitized as well as interest rate space to deliver value. So I think there'll be a lot of disruption, and what makes me excited is thinking about what opportunities that will present.
Well, that's encouraging to hear. It's been a pleasure talking with you, Mohit. Thanks for sharing your latest insights with us during this challenging and unusual time in the market.
And lastly this week, we break down the basics and benefits of 529 college savings plans.
There are a few ways to save for college, and one of the most often used is the 529 College Savings Plan. With a 529 plan, you can contribute after-tax dollars into an account that then grows tax-free and can be withdrawn tax-free to cover qualified educational expenses like tuition, mandatory fees, books, a computer, internet access, and room and board. You can also use a 529 plan to pay for grad school, trade school, and in some places, even K-12 private education. If after all the educational expenses are covered, you can even transfer the remaining funds to some family members, including parents, siblings, step-siblings, first cousins, and some in-laws. Certain states offer tax benefits for their 529 plan. However, if your state does not offer attractive tax benefits or another state's 529 plan is more appealing, you may also be able to contribute to that 529 plan. To sum it all up, 529 plans offer tax benefits that let you spend tax-free money on qualified educational expenses, and you should start your research by checking with your own state. For more information on 529 plans, visit Morningstar.com.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.